So in this chapter, we're going to be talking more about performance measurements and responsibility accounting. The goal here is to distinguish between direct and indirect expenses and identify bases for allocating these between departments. So we're really talking about departmental accounting when we talk about responsibility accounting. Talking about joint costs across products, transfer pricing, and how we set prices. And then really how we analyze investment centers and some of these return on, and some of these concepts that I think are really helpful, like return on investment, residual income, profit margin, investment turnover, the balanced scorecard, and the cash conversion cycle. I'm going to have you memorize those formulas, and they're just something you need to know for the rest of your financial education. After that, we'll just talk about how we might prepare some of these reports and allocate some of these other expenses to different departments. And so being in a large companies is very different than being in small companies. In large companies, you have divisions, and they're divided into units, sometimes they're called divisions, sometimes they're segments, sometimes they're departments. And in this kind of decentralized organization, decisions are made by the unit managers instead of top-level management. A good example, you can think of any big companies run this way. Ford, you can think of Apple, I'm sure. The companies that I've worked for, when they're big, your boss will be the head of your division, who reports eventually to the CEO, but there's just too much of an organization, too big for us to get directly to management. So management really has to allocate to other managers, these middle level managers, but these middle level managers can be the head of specific divisions. And so these decentralized organizations are normally bucketed into three different types. We have cost centers, profit centers, and investment centers. So a cost center is measured by success, generally by how well they control costs. And so accounting is generally going to fall into a cost center. If you're working for a bigger company. So they're going to ask you to go in and determine how can we keep accounting costs as low as possible? How can we make sure that we're reporting the information for the most efficient way as possible, and making sure that the company doesn't blow a bunch of money? How are we managing our costs? That's normally a cost center's job. A profit center is evaluated on their success in generating income. And so some accountants can assist profit centers. That's what I do in my day-to-day. I'm a revenue accountant. But our job will still be focused, what we consider more of a cost center, while managing our costs, while helping the sales team or the engineering team or the engineering sales team focus on generating profits for the business or selling products. And then the investment center evaluates the use of investments to generate future income. And so that might be buying stocks in the market, that might be buying real estate, but the whole job of this is to invest in something outside of the core activities of the business. Well, this is the core activity of the business. And the investment might be in the future of the business, but profit center is focused on selling products today. Cost center is make sure we don't spend too much today. So how do we do this with the concept of controllable costs? Take notes, difference between controllable and uncontrollable. So first, memorize, from a homework perspective, memorize these different types of centers, and we kind of talk through what might be different parts of these centers. From a memorize controllable costs versus uncontrollable costs. Circle controllable. Controllable, a cost is a controllable cost if a manager has, I circle, the power to determine or at least significantly affect the amount incurred. I'd say controllable is the amount to determine amount incurred. That's really what I'd focus on here, is if we can control it, if a manager can actually have an influence over it. So it's a good example here is a manager can control how much supplies they use for their department, or they can decide how much food they buy for their team. They can decide how many employees they hire to some degree. Uncontrollable costs might be the department manager's salary, or costs that are not within the manager's influence, or maybe the rent of the unit they're using, of their portion of shared rent. So the idea here is what can you control versus not control. Good example, if you live in the Bay Area, not much you can do about change. If you're talking about a personal perspective, there's not much you can do about your rent. Rent's going to be kind of expensive. But what can you control? You control your food costs, you control your how much you drive, et cetera, et cetera. So we focus on the things we can control, not the things we can't control. So what's a responsibility accounting system? It's an accounting system that provides information to the direct managers and the managers on controllable items. So we want to be able to evaluate the managers on what they can control and tell the responsibilities of those managers to other managers and their staff. And so here's a good example of how a company is structured. Hopefully we understand this from Business 101, but we have the board of directors. The board of directors oversees the general operations, the very high level operations of a company by being appointed by the investors. Investors appoint a board of directors to represent the investors' interests. The board of directors then hires officers to run the day-to-day of the company. And so those officers, generally there's a president and CEO, and then that they hire people to run maybe the regional divisions, or they might run product divisions. Here they're saying regional, so we have Europe, USA, Asia. The USA runs West and East region. The West region is then broken out into products. So planet manager for beverage, food, and services. So each one of these will be a very high level, like a vice president of a West region is a very high level person, but he oversees this while the executive vice president is overseeing both the East and the West region, so on and so forth. And so that accounting system would help them control cost over all of these levels of management. And so a performance report has to have the amount of detail that varies according to the levels in the organization. So a department manager receives detailed reports, maybe of all his stores or his department stores, but a store manager receives summarized information from the department manager and able to know what he needs to be selling. Maybe he needs to know the pricing of his products, but so he can flow it through his stores. But then the department manager also needs to know all the information related to the store manager in order to run his department. So we go back and forth to determine there needs to be some kind of back and forth intermingling of information, and that's where this accounting system interplays. And I've seen systems where you see the department, you see who runs it, and you can go into that and see the costs related to that department and that department's goals and so on and so forth.